Dividend investing has been surging in popularity over the last couple of years, with content creators talking about it in multiple online communities on Discord, Reddit, with thousands and millions of people showing off what they're investing in and the dividends that they're receiving every day. Today, you're going to learn that dividend investing is the truest form of passive income. There's nothing better than getting paid cold hard cash from investing some of your favorite companies. Dividend investing is also appealing because you can get a form of cash flow without selling your stock position. Dividend investing is also an amazing way to build generational wealth, evade taxes legally, wink wink, grow your patience in my opinion, and much more as you will learn in the video. Today I will be covering everything you need to know about dividend investing. And guys, if you're new to the channel, this is going to be the highest quality video that I've ever made, the longest video that I've ever made, so it would mean a lot real quick if you could help me reach my goal of 1,000 subscribers by subscribing. Share this video with somebody that you think would find it valuable. Smash the like button while you're at it, and of course, roll the intro.
Hello, I like money.
To start the video off, we're going to state the obvious. What is a dividend? A dividend is a distribution of profits from a company. As you know, businesses make profits. With those profits, they'll rather reinvest back into their own business, or they can reward shareholders using share buybacks, dividends, and special dividends even. When you buy stock of a company, the company is using that money from the stock that you purchased to help, grow their business essentially. Then the management takes that money, they'll reinvest it, hopefully make more money with that dollar that you put into the business, and reward you, the shareholder, with dividends. Typically, older companies, for example Coca-Cola, will have a larger dividend. This is because they don't need to reinvest back into their business actively. But with companies like Visa, Microsoft, and Apple, they'll typically pay a smaller dividend and grow the dividend more. This is because of the massive growth potential of the business that they're in and the untapped markets. At the end of the day, Apple and Microsoft are going to have to invest a lot more money to grow their business than Coca-Cola will right now. Now let's talk about dividend yield. Dividend yield is a financial ratio showing the return that an investor would earn based solely off dividend payments. An easy way to understand dividend yield is annual dividend divided by the current stock price, or if you invested $100 into a stock, that would be the return you're getting in dividends for every $100 that you invest. Right now, Coca-Cola's dividend yield is 2.83%, so if you invested $100 in Coke stock, you would be getting $2.83 in dividends every year from that $100 in stock. But be aware, dividend yield can be deceiving. An unusually high dividend yield usually means that the core business that you're investing in the stock is not very good and that a dividend cut may be coming. Typically, the highest dividend yield that I'll invest in is 5%. If the dividend yield is from anywhere to 7 to 10%, then I start getting a little concerned. But this could be a lie, because not all high yield stocks are bad. A high yield dividend stock that I own is Altria, stock ticker MO. Altria currently has an 8.28 dividend yield. If this were any other company, I'd be alert or concerned, but this is why you need to do research on these stocks, guys. Naturally, since Altria is in the tobacco industry, they're going to be traded at a discount. Due to this, their stock price will not align with their dividend really, and the financials that they produce every quarter. Altria's current dividend is pretty safe looking at their financials right now, and they even just increased the dividend. Now, let's actually talk about receiving your dividends. A company's board members will usually agree on a set dividend. The day that happens is called the declaration date. If you want to receive the dividend, you need to buy the stock on the ex-dividend date. If you don't own the stock on the date of record, then you will not receive the dividend for that quarter. For me, I try not to focus on the timing of buying my stocks. I more look at, the valuation of the stocks, which we will get into later. From then, as long as you hold on and do not sell your shares, you will get the dividend. When you receive your dividend, you could do two things with it. One, you could just take the cash straight up, do whatever you want with it, invest it in a different company, or take the money, use it for personal reasons. Or you could reinvest the money into that stock and allow for a bigger payment next time you get the dividend. Now, your choice here really relies on your situation. If you're like me, I'm 17 years old. I reinvest all my dividends because it's shown that you generate a lot of wealth over time if you reinvest your dividends for a long period of time. But let's say you're older, you're close to retirement, you need the money, or you're living uncomfortably right now, it would be okay to take the dividends out, or you're using it to pay for bills or something to get your credit score up. But you can see in the chart here, over a long period of time, the significance of reinvesting your dividends. As I mentioned, you guys can see in the first about 15 to 20 years, there isn't a humongous difference with the reinvested versus not reinvested dividends. Then you guys can see over time, compound interest does its job, and the reinvested dividends significantly outpaces and outgrows the dividends not reinvested. Reinvesting your dividends only really works on a long time horizon, so again, if you're older, it may not be the best option for you. Warren Buffett got something crazy like 98% of his wealth after the age he turned 50, which is crazy, and it also just, proves my point that compound interest is very real, and it only works on a long time horizon. Now, let's get into how to pick stocks that you want to buy in your dividend portfolio now that you understand how dividends work. I'm an advocate if you don't want to do the research into these own stocks and you don't want to build your own portfolio, buy an ETF like SCHD, VOO, VTSAX, or go research some. But I also do think some people should own some really high quality stocks in their portfolio. The most popular valuation metric is called the PE ratio. A company's PE is the share price divided by the earnings per share. Typically, a fair considered PE ratio, so you're paying a fair price for the stock that you're owning, is 20 to 25. But this does vary on the valuation and the quality of a company that you're investing in. For example, a high-quality company like Microsoft or Apple, it's definitely reasonable to pay, a 25 PE for them. And then you got, lower quality companies with low PE ratios. For example, Intel, AT&T. But for me personally, if a high-quality company that I'm interested in is near the 25 mark, I'm definitely willing to pay that price. The next metric I look for in buying a good stock is if it has positive free cash flow. Free cash flow, in my opinion, is one of the most important metrics when looking at a stock to buy. Free cash flow is a company's operating cash flow minus capital expenditures, and the result of that is free cash flow. Free cash flow can be used to do a multitude of things. Share buybacks, which we'll get into, dividends, special dividends, capital expenditures, which is basically just reinvesting into your business. For example, Apple wants to, build a new plant for iPhones. That's capital expenditures. And obviously, when you buy a stock, you buy a part of a business, and you want that business to be positive and free cash flow so they can keep on growing as a business and grow your wealth as a shareholder. Now, we're going to look at some good and bad examples of free cash flow when you're looking at a chart. A good website that I like to use is Macro Trends. It's very easy to understand for beginners. Here's our good example of free cash flow. We got Microsoft. Obviously, free cash flow is another indication of, just the ability of a business to really adapt to the economy and customers' needs as well. Here you can just see large and more important, consistent free cash flow growth. I'd much rather prefer, consistent free cash flow growth over large and not so consistent free cash flow growth. Now let's move on to one of our bad examples. We have everybody's favorite movie company, AMC. We could say even prior to COVID, AMC just had inconsistent, small free cash flow growth. No growth at all over those 5 years, and then COVID hit, and you could just see the terrible free cash flow what happened there. Another example of negative free cash flow, unfortunately, Macro Trends wouldn't let me pull it up for some reason, but it's going to be Disney. Disney paid a dividend prior to COVID. COVID happened, and then, of course, what happened with Disney there. And Disney's free cash flow from them has just been inconsistent. 2 quarters ago is up, and now it has just been trending down. So hopefully, with Bob Iger coming back, that free cash flow can go in a positive direction. Now, let's talk about how if you know a dividend is safe or not. The first way to really tell if a dividend is actually safe or not is, if the business itself is strong and it's updating to the current economy, it's making new adjustments to grow their business and expand. And especially if it's not in like a dying industry, for example, like a coal company, you're going to also want to make sure you're looking at earnings, etc., and make sure, they're not declining in earnings. But the best financial metric to really determine if a dividend is safe or not is called the payout ratio. The payout ratio is basically the percentage of the free cash flow of a company that they'll pay out in dividends. Typically, the more mature the company, the higher payout ratio it's going to be. For example, Coca-Cola and Pepsi, they're more in like the 60 to 70% range. With companies like Microsoft and Apple, their payout ratio is going to be much smaller because they're still reinvesting a lot of money back into their business and to grow. Another thing to be aware of with payout ratios, if you're investing in a company like a REIT or a real estate company, they are legally required to pay out 90% of their earnings in the form of dividends. So please ignore it if their payout ratios are much higher. Now let's take a look at some positive and negative examples of payout ratios. To start off here, we're looking at Kroger right now. Kroger's payout ratio is 22.71%. Personally, for me, I like to see anything below like 55-60%. The highest I'll ever be looking up, it obviously depends on like the maturity of a company, would be around 75 to 80%. But as you guys can see, 22.71%, that's amazing. Kroger can still grow that dividend and reinvest money back in their business at the same time. So definitely that's one of the better examples in the stock market of great payout ratios. As I mentioned, you want to invest in good businesses that are growing their earnings. This is the stock VF Corp. It's actually in my portfolio. I have not added to it in a while, and you guys will see why right here. Their payout ratio is 76.34%. Right now, their dividend growth is not great at all as well. Their earnings are not growing, so there's a good chance that this dividend could be cut in the future. 76%, they're skating on thin ice, I'd say for sure. Now, let's go and pick some stocks. For me personally, I think the ideal amount of positions to have in a portfolio is 15 to 20. Right now, I own 30. I think I own too many, to be honest. There's a saying, invest in what you know and invest in what you use. And that was kind of my approach to, starting off investing. You want to find high quality businesses that you notice trends in society that are like growing. Let's say you drive by Starbucks every day and you see that it's always packed there. Or you go by Texas Roadhouse, you see it's always packed there. McDonald's, the drive-through is crazy. So I would definitely try to notice trends when you're out and about in the real world. For example, me personally, I saw Target was always packed, and people, I noticed family members as well, would always prefer to shop at Target. Research Target stock, realized it was a stock that really aligned with my goals personally, and I bought it. I try to buy into companies that I envision being in our society, present and growing in the next century. You want to invest in companies that obtain an economic moat. An economic moat is basically an advantage that one company will have over another, whether it be their brand. For example, Disney has an advantage over other, animation companies because of their brand value. Starbucks has an advantage over Dunkin' Donuts because of, their brand value and the ingredients they use, etc. McDonald's, their moat is their consistency, etc. This is one of the biggest things that legendary investor Warren Buffett looks for in his companies, and here's a clip of him just talking about the economic moat and its power.
Yep.
What are the key indicators you look for within companies before making an investment?
Well, I look for something that does give them a moat around it. We have a company called See's Candy out on the West Coast. See's Candy is boxed chocolates. If you give a box of See's chocolates to your girlfriend on the first date and she kisses you, we own you. We can raise the price tomorrow and you'll buy the same box. You're not going to fool around with success. So the key there is the response. You do not want to go home on Valentine's Day and say to your wife or your sweetheart, preferably they're the same person, you don't say, here, honey, I took the low bid. It doesn't work. Price is, to a degree, is immaterial. If you've got an economic castle, people are going to come and want to take that castle away from you. And you better have a strong moat. You better have a knight in the castle that knows what he's doing.
You're not buying an asset. You're buying a name, you're buying a brand, you're buying a real franchise here.
As I've mentioned multiple times in the video, when you're not just buying a stock, you're buying a business. You want to also make sure the business that you're investing in has good management and, more importantly, a great leader as a CEO. You want to listen to some interviews with some CEOs. Personally, some of my favorite CEOs are Tim Cook, Howard Schultz from Starbucks, Bob Iger from Disney. Those are a few of my favorite CEOs. You could usually read, their body language and how sincere they are really as a person. And, it gives you a level of comfortability when you have somebody that you can really tell it's made for them. Their job is made for them. For example, Howard Schultz, he's unretired and came back from Starbucks a multitude of times just because of how much he loves that job and his role in the company, which is really somebody that you want in charge of a company. Right now, we're living through a classic example of inflation happening and companies having to raise prices. You want to find businesses with really loyal customer base that will pay no matter any price for the product. You want to find companies like Starbucks, in my opinion. Starbucks is an example of a company that has a really addicting product as well. You also want to find a company that has consistently and makes it a priority to reward shareholders in the form of dividends, share buybacks, etc. Make sure to not invest in a company solely for the dividend. This is a mistake that I made with AT&T stock. I invested just straight up for the 7%, dividend yield that I bought at the time. It was one of the earliest stocks that I bought, and I really didn't care whether the stock price went up or down. You also want to look back and see how the companies have done through, troubling times. For example, the pandemic that happened 2 years ago, how did they react? Did they cut their dividend? How did their earnings look after, etc.? What was the management's reaction? How did they treat their employees during this time? This is all important things that you need to know before you invest in a business, aka a stock. Now, let's talk about diversification in the different sectors. It's really important to have a diversified portfolio, so you don't want to have, for me personally, more than 10% of one position making up your portfolio. For me, there are only a few companies that I really want over 10%. The three off the top of my head would be Apple, Microsoft, or an SCHD, or a different type of ETF, broad market ETF. Now I'm going to show off the different types of sectors towards newer investors so you guys know what type of stocks these are. To start off, we got the healthcare sector. A stock from this sector would be like Johnson & Johnson. Then we got materials. A stock from the materials sector would be like Lind. Then you got the real estate sector. An example of a real estate company would be like Realty Income, Vici, or Stag. Consumer staples, Coca-Cola or Pepsi. Consumer discretionary, that'd be like Starbucks or maybe Target. Utility sector, NextEra Energy. Energy sector, which are like gas companies, so Chevron or ExxonMobil. Do not get those mixed up. I got those mixed up when I started investing. Utilities, I thought was like clean energy, and so NextEra Energy would be like a clean energy stock. Industrials, 3M. Consumer services, TMS International is a good consumer services. Financial sector, which is like banks, I'll say Ally. And then technology, you could do Apple or Microsoft for that one. Those are the different sectors, and of course, it's always important to diversify, because if one sector goes down tanking and you're just investing in all that, then your whole portfolio will tank. Now we're going to learn about the importance of dividend growth, a subject that I've been highly informed on and learned a lot about in this last year. Think of your dividends as a paycheck from your work or your company, and a dividend growth is basically an increase in your salary, an increase in your paycheck, the increased amount you get paid. And that's kind of the view I took on dividend growth and why it's so important to me right now. If you're very young like me, you're under the age of, let's say 30, it's very important that you get a good combination of, high yielders with low dividend growth. But a majority of your stocks, I say, should be, very high dividend growth. What is high dividend growth? High dividend growth for me personally, a 5-year CAGR of over 10%. Dividend growth is an amazing way to combat inflation as well. You guys can see in this chart illustrated by dividend growth, you got in green the dividend cutters and eliminators. Orange, you got the dividend non-payers. Yellow, no change in dividend policy. Green, the equal weighted S&P index. Dividend payers in blue, and then in light blue, dividend growers and initiators. And you guys could just see how much dividend growers over the long term. This, again, guys, dividend growth is not for the short term. You guys can see that light blue is very close to blue, green, and then orange. But then over the long term, you guys could see that light blue just completely skyrockets. The dividend growers, compound interest does its work and just completely takes off from there. Dividend growth also adds to your yield on cost when you buy a stock. So if you invest in high dividend growers and you reinvest those dividends back in those companies, it's definitely a formula to gain some serious wealth over a long period of time. And I emphasize a long period of time. You guys, you need to be investing, with this money for the rest of your life, to be honest. Everybody should be investing for at least 10 years when they want to open a position. Don't intend to sell a stock when you buy it. That's kind of the approach that I took personally when I'm looking to buy stocks. I don't plan to sell them anytime soon. And that's another great thing about dividend investing. You don't need to sell your position in a stock, and you could still create good passive cash flow with that. This is Warren Buffett's net worth over time, and you guys could just see how similar it is really to the dividend growth stocks. Just later on in life, compound interest doing its work and generating crazy wealth over the long period of time. Now let's talk about something that nobody likes, which are taxes. Dividends are actually a great hedge against taxes and to pay less taxes as well. Here you guys can see how dividends are basically taxed. I'm not going to go through and read every single one of them, but you can see the significant difference between income tax rate and capital gains rate. You see you're saving obviously between 10, 15, even 20% on some of these when you're investing in dividend stocks, which again, great benefit to investing in dividend stocks. If you don't want to pay taxes at all, invest in a Roth IRA. If you invest in a Roth IRA, you can't take the money out unless you could actually, but you'll be penalized, but you can't take the money out till retirement, but you will save a lot on taxes, so that's a benefit for sure. So when you get your dividend, what do you want to do with it? Let me know in the comment section personally what you do with your dividends. What I plan to do with my dividends, right now I'm just reinvesting them, letting compound interest do its work as I showed in the graph, but eventually I plan to use them for different types of investments, fuel, real estate, down payments. Again, guys, compound interest is going to do its work over the long term, and you could use these dividends for so many different things. And guys, the last part of the video, if I want to leave you on one thing from this, it only works in the long term. I repeat, this is not a get-rich overnight scheme. This is for the long term. And there's a saying that time flies, so why not make money with time, you know? And with that, guys, that is everything that I think that a beginner should know about dividend growth investing. Again, guys, long-term time horizon for this, guys. It only works long-term. I really want to thank you for making it to the end of the video. It really means a lot to me because I'm trying to get monetized by the end of the year. So it means a lot if you actually watch the full video. I appreciate it a lot. Make sure to subscribe if you haven't already. I spent a lot of time on this, making this. I think it's going to be one of the highest quality videos that I've made yet to date. It would also mean a lot if you could share the video with somebody that you think would find this useful. Join the Discord, the link is in the description. We share our buys, our sells, our dividends received. Go watch my last video on my channel's portfolio update. Again, subscribe if you want to find out, learn more about dividend investing. I'm learning and growing as well with you guys, which I believe in transparency. So thank you again for making the video. And of course, do dividend stocks, not drugs. Have a great one.